The United States currently carries a national debt of roughly $38.4 trillion as we sit here in mid-January 2026, with the precise figure from the Treasury's debt to the penny dataset clocking in at over $38.43 trillion just days ago on January 9, 2026. This isn't some distant projection or future worry, it's the actual amount recorded on the government's books right this moment, climbing steadily day by day through deficits that show no signs of slowing. If anyone still thinks this enormous sum has zero bearing on their personal finances, everyday costs, savings, or future security, it's time to pay very close attention to the quiet but profound changes unfolding behind the scenes in global finance. While much of the public remains distracted by daily routines, entertainment, and endless online content, the planet's most influential banks, sovereign wealth funds, central institutions, and ultra-wealthy investors have initiated a deliberate, large-scale reallocation of capital away from dollar-based holdings. This movement isn't hidden in shadows or based on unverified claims. It's reflected plainly in public Treasury International capital reports, official filings from major holders, monthly TIC data releases, and balance sheet adjustments disclosed by the world's biggest asset managers. These shifts represent trillions in repositioning, executed methodically and without fanfare to avoid market disruptions. By the time you've read through this entire breakdown, the full picture should become crystal clear. What's driving this exodus, the historical precedents that make it predictable, the exact stage we're in within a well-established cycle, and most critically, the probable sequence of events that follows if the pattern holds true, as it has every previous time. Over the last half-millennium, a precise, repeatable four-phase dynamic has toppled three successive global reserve currency powers. The stages align mathematically with debt trajectories, capital flows, interest burdens, and confidence erosion. We're not witnessing something entirely novel, we're observing the same script playing out once more, only this time with the dollar at center stage. To set the broader context, worldwide indebtedness has stabilized at levels exceeding 235% of global GDP according to the IMF's most recent assessments in their Global Debt Database updates from 2025. That's an extraordinary peacetime ratio, far above historical norms, with total global debt hovering in the range of $300+ trillion when combining public and private obligations across nations, though public components alone have pushed past $100 trillion in recent tallies. For the United States in particular, the federal debt alone escalated dramatically from about $36.1 trillion at the start of 2025 to the current $38.4+ trillion figure now, representing an addition of more than $3 trillion in roughly 12 months. Yet the truly alarming aspect isn't merely the raw growth, it's how closely this trajectory mirrors the final chapters of prior reserve currency dominances, where sophisticated capital flight preceded full loss of status within a compressed 18 to 36-month window. This isn't random or coincidental. Economic history documents a consistent four-stage arc that has repeated across centuries whenever one nation achieves unchallenged monetary supremacy. The first stage involves ascent and consolidation. A country rises to become the undisputed focal point of international capital. Inflows arrive from every corner of the globe seeking safety, yield, and opportunity. The nation's currency solidifies as the default medium for worldwide commerce, invoicing, reserves, and settlements. Financial markets deepen, innovation flourishes, credit expands rapidly, and widespread belief in perpetual prosperity takes root. This foundational era frequently endures for 50 to 80 years, building layers of institutional strength and psychological confidence. The second stage brings overreach and leverage, triumph breeds complacency and extravagance. Governments fund ambitious military ventures, extensive foreign commitments, generous domestic welfare expansions, infrastructure megaprojects, and crisis responses entirely through borrowing rather than balanced revenues. Public liabilities accumulate faster than underlying economic growth can support. Still, alarm remains muted because rising asset valuations, real estate surges, equity indices climb to unprecedented heights, luxury markets boom, create an illusion of universal wealth. Central banks accommodate by expanding balance sheets and suppressing yields, perpetuating the cycle. This inflationary prosperity phase commonly stretches 20 to 40 years. The third stage marks the discrete departure. Perceptive capital, those with direct access to detailed financial statements, forward projections, and insider risk assessments, begins exiting. No dramatic announcements, no coordinated press campaigns, simply calculated, incremental rotations into alternative havens. Foreign official accounts pare back exposures gradually at first, then more decisively. Private wealth managers for high net worth families and institutions diversify geographically and into non-dollar denominations. Hedge funds adjust allocations, pension overseers hedge currency risks, and multinational corporations redirect investment flows. The process accelerates quietly over 18 to 36 months, draining liquidity from the core system without immediate panic. The fourth stage delivers the unraveling. Reserve currency privilege erodes irreversibly. Overseas central banks accelerate sales of holdings to minimize losses. Demand for the currency collapses as trade partners shift to bilateral or regional alternatives. Inflation surges as repatriated capital floods back home, interest expenses explode upward, borrowing costs become prohibitive, asset bubbles burst in unison across equities, property, and credit markets. Banking systems face cascading failures, retirement vehicles lose massive value, insurance liabilities become untenable, governments confront political upheaval, and the broad middle class, whose wealth resides predominantly in nominal dollar terms, experiences devastating erosion of purchasing power and net worth. In hindsight, the question echoes across generations: how could the warnings have been so clear yet so widely disregarded? 3 concrete historical cases illustrate this progression with striking fidelity. Consider Spain during the 1500s, the preeminent global power without rival. Vast treasure fleets transported unimaginable quantities of gold and silver from the New World colonies. The Spanish real functioned as the de facto world reserve unit. International merchants required it for transactions. Madrid stood as the financial nerve center of the era. Military might extended across continents. The empire controlled enormous territories in Europe, the Americas, Asia, and Africa. Stage 1 appeared unbreakable. Then came unchecked expenditure. Protracted wars against France, England, the Ottomans, the Dutch rebels, upkeep of sprawling garrisons, opulent royal courts and cathedrals, enforcement apparatus including the Inquisition. By the mid-16th century, crown outlays routinely tripled annual tax collections. The shortfall was bridged through loans from Genoese, German, and Italian bankers at escalating rates. New World bullion inflows initially concealed the imbalance. Domestic asset prices inflated wildly, fostering a false sense of invincibility. Stage 2 fully engaged. Insiders, however, read the ledgers differently. Around 1555, prominent Spanish banking dynasties began relocating operations and wealth to Genoa. The powerful Fugger financiers, major creditors to the crown, insisted on repayment in physical bullion rather than further promises. Wealthy traders quietly established bases in Amsterdam, rerouting commerce. Interest demanded on new borrowings reached 40% in some instances, a glaring distress marker in official records. Stage 3 unfolded methodically. Defaults cascaded. 1557 marked the first outright suspension, followed by repetitions in 1560, 1575, 1596, and beyond, 4 major episodes within 4 decades. Credit access vanished, bonds turned worthless, authorities confiscated incoming shipments to pay troops. The real depreciated sharply, price levels soared destructively, eroding savings and commerce. By the early 1600s, Spanish hegemony had dissolved permanently. Capital and talent migrated decisively northward to fuel the rise of the Dutch. Next, examine the Dutch Republic in the 17th century. Amsterdam eclipsed all competitors as the wealthiest, most sophisticated financial metropolis. The Dutch East India Company achieved valuations rivaling the combined market caps of today's largest corporations. The guilder became indispensable for global settlements. The Amsterdam Exchange pioneered modern stock trading, futures, and options. Capital converged from Asia, Africa, the Americas, and Europe, seeking the highest returns and safest custody. Stage 1 reached its zenith. Success invited excess. Successive Anglo-Dutch naval conflicts, wars with France and Spain, colonial defense across vast distances from Indonesia to the Caribbean. Government obligations multiplied 20-fold between 1650 and 1690. To finance it, authorities leaned on money creation and fractional practices at the Bank of Amsterdam, which secretly extended credit beyond reserves to support state ventures. Meanwhile, the infamous tulip bubble detached asset prices entirely from fundamentals. Bulbs traded for multiples of skilled workers' lifetime earnings. Stage 2 manifested classically. By the 1690s, discerning families and merchants commenced transfers to London. Sephardic networks, Portuguese traders, and German houses opened English branches and redirected flows. They recognized the central bank's underlying insolvency. New deposits quietly covered old obligations for decades in a de facto Ponzi structure. Stage 3 proceeded steadily. The 1795 French invasion exposed the rot. The Republic collapsed, the guilder plummeted, depositors faced total losses, civil disorder erupted. The Dutch Golden Era vanished abruptly after 150 years. Capital decisively relocated to Britain, setting the stage for the next hegemon. Finally, the British Empire from the 18th to 20th centuries, the most extensive dominion ever, governing roughly a quarter of humanity and landmass. The pound sterling reigned supreme for over 2 centuries as the anchor of international finance. London banks underwrote global railroads, mines, plantations, and trade everywhere. More than 60% of cross-border transactions cleared in pounds. The classical gold standard revolved around sterling convertibility. British financial dominance seemed eternal. Stage 1 lasted exceptionally long. The 20th century's cataclysms changed everything. World War I imposed costs equivalent to trillions today, pushing debt from 30% to 130% of GDP. Gold linkages strained and broke in 1931. World War II compounded devastation. Victory came at the price of near-total exhaustion, massive American loans, and loss of overseas assets. Stage 2 concluded with structural insolvency masked by wartime unity. From 1949 onward, the withdrawal gathered momentum. Multinational firms like Unilever and Shell redirected capital overseas. Affluent Britons moved funds to Switzerland, Canada, and the United States. Skilled professionals emigrated en masse for better prospects. Foreign direct investment inflows collapsed by over 60% from pre-war norms. Stage 3 accelerated. The pound suffered a sharp 14% devaluation in 1967 when reserves proved inadequate to defend parity. By 1976, the once mighty empire sought an IMF bailout, an unthinkable humiliation. Sterling forfeited reserve primacy. Global trade pivoted overwhelmingly to dollars. Britain's long financial supremacy ended definitively. 3 distinct eras, 3 currencies, 1 unchanging blueprint spanning 500 years. Now overlay the United States' trajectory since 1944's Bretton Woods Agreement, which crowned the dollar as the linchpin, initially gold convertible at $35 per ounce, later fiat after 1971's Nixon shock. Post-World War II devastation elsewhere funneled capital here, U.S. Markets became the deepest, most efficient globally. Dominance solidified through the 1970s. Stage 1 completed. Post-1971 fiat freedom unleashed borrowing, debt from under $1 trillion in 1980 to $5.6 trillion by 2000, $10 trillion post-2008 crisis, $27 trillion by 2020, $36+ trillion early 2025, and now $38.4+ trillion. Including corporate, $13+ trillion, household, $18+ trillion, student, $1.7+ trillion, credit card, $1+ trillion, auto, and medical obligations, aggregate U.S. Debt surpasses $100 trillion, approaching or exceeding 370% when measured against GDP in broader terms. Government debt to GDP alone hovers near or above 124% recently, already past Britain's collapse threshold of 130% and approaching Dutch/Spanish danger zones. Annual interest now exceeds $1 trillion, surpassing defense outlays, Medicare spending, or most cabinet departments, paid simply to service old borrowing, not reduce principal. Funding relies heavily on money creation. M2 expanded explosively post-2020. The Fed's sheet ballooned from under $1 trillion pre-crisis to $9 trillion peaks. Assets inflated across classes, stocks at stretched multiples, housing up dramatically since 2019, everything detached from wage growth. Stage 2 concluded emphatically. We now reside squarely in Stage 3, the silent capital rotation. China trimmed Treasury holdings from peaks above $1 trillion to roughly $700 to $800 billion in recent data, around $700 to $760 billion in late 2025 reports. Japan, the top foreign holder at over $1.1 trillion recently, has moderated accumulations and occasionally reduced positions amid yen dynamics. Saudi Arabia explores non-dollar oil invoicing flexibility. Belgium, Switzerland, France, and others pare exposures incrementally. The Fed itself engages quantitative tightening, allowing maturities without full rollovers. Replacement buyers? Predominantly domestic, intragovernmental accounts, pension funds, the Fed's own legacy holdings, creating a circular, self-reinforcing loop that's unsustainable long-term. Institutional evidence abounds. BlackRock, $10+ trillion AUM, has publicly shifted toward emerging markets, infrastructure abroad, commodities, and gold to hedge dollar concentration. J.P. Morgan, Goldman Sachs, Morgan Stanley issue guidance favoring international diversification, reduced U.S. equity overweight. Bridgewater and others have positioned explicitly against dollar overvaluation for years. BRICS mechanisms expand rapidly. Yuan/rupee settlements between China/Brazil, India/Russia, alternative payment rails bypassing SWIFT/dollar dominance. Over 40% of global output now aligns with BRICS plus frameworks building parallel systems. The petrodollar understanding. Never a rigid treaty but a long-standing arrangement, shows cracks, with Saudi Arabia openly considering yuan or other units for oil sales. Stage 4 looms as the logical extension, gradual then sudden reserve erosion. Trade invoicing diversifies, dollar demand wanes, foreign-held dollars repatriate, domestic inflation accelerates violently. The Fed confronts an untenable binary: aggressive rate hikes, crushing debt service, triggering deep recession, asset crashes. Or continued accommodation, fueling hyperinflation spirals. Either route devastates dollar-denominated wealth, stocks deflate, real estate corrects sharply, bonds lose principal, banks face runs or failures, pensions and insurance implode. The middle class, holding most savings in cash equivalents, deposits, bonds, and equities, suffers catastrophic real wealth destruction. Critics insist America differs. Unmatched military reach, technological edge, elite universities, innovative corporations. Yet Spain wielded the era's supreme armies, the Dutch pioneered finance capitalism itself, Britain commanded the largest empire and industrial base ever. None overcame arithmetic reality, excessive leverage, eroding confidence, capital flight. Printing proved catastrophic in Weimar, wheelbarrows of marks for bread, Zimbabwe, $100 trillion notes worthless. Venezuela, millions% inflation, societal breakdown. Argentina, repeated resets, chronic stagnation. Money creation doesn't generate real resources, it reallocates from savers to borrowers until trust shatters, then accelerates collapse. We're approximately 12 to 18 months into Stage 3, judging by accelerated foreign treasury sales and institutional reallocations starting prominently around 2024 to 2025. Historical windows suggest limited remaining time, months, not decades, to reposition. Immediate, practical implications demand action. Diversify aggressively beyond heavy dollar concentration. Consider timeless hard assets like physical gold and silver, which have preserved purchasing power through every prior monetary transition over millennia, along with select commodities immune to printing presses. Incorporate geographic spreading. Allocate portions to jurisdictions with strong rule of law, sound fiscal histories, stable units, Swiss franc zones, Singapore, perhaps Nordic havens, to dilute single-nation political and currency risks. Prioritize liquidity, maintain accessible cash or equivalents despite inflation erosion, because crises create bargains for those with dry powder to deploy when others cannot. Eliminate or sharply reduce high interest, variable rate debt. Rising structural rates turn leverage into a trap. Invest relentlessly in irreplaceable human capital, marketable expertise, problem-solving abilities, trusted networks. These endure confiscation, inflation, or market resets. Remain vigilant with primary data sources, Treasury releases, IMF updates, TIC flows, because patterns surface in numbers long before mainstream narratives acknowledge them. This analysis draws from verifiable records, not conjecture. The $38.4 trillion debt level exists for tangible reasons. Foreign divestments accelerate for mathematical ones. Institutional behavior shifts for risk management ones. The cycle has proven indifferent to exceptionalism claims throughout history. The unfolding process doesn't pause for disbelief or require majority agreement, it advances relentlessly, driven by incentives, arithmetic, and self-preservation among those who move earliest. What steps are you considering? Where do you see divergences from the pattern? Share your perspective. Deeper explorations ahead will detail specific asset classes and sectors that historically shielded or multiplied wealth through comparable fourth-stage environments, drawing from Spain's defaults, Dutch implosion, British devaluation to illustrate concrete positioning options. Awareness combined with timely resolve defines who navigates these transitions successfully versus those left wondering how the signals escaped notice when they were embedded in plain sight all along.